Good day to you all. Good afternoon, good evening, wherever you are. I think looking at the audience tonight, I think we have a big South African audience, so I guess it is good evening. Thanks for joining us. Thanks for putting your dinner on hold. We're going to do things a little bit differently. For those of you who have been to our webinars in the past, we're going to showcase a few more of our team. And of course, we'd like to welcome my co-panelists tonight, Emma Swart and Scott Shearing. Scott, who you have probably never seen before, is part of the deals team sitting in Atlanta, and his punishment is to crunch through all the buildings that get sent to him and try and find the gems out of all of the buildings that we find on and off market. So this is a building that he has actually sourced himself, the building that we're going to talk about tonight and deep dive into. And so he's quite passionate about it, and it's good to have him tell us firsthand what he's learned about building number 41. So on that note, let's move on and introduce you first, Scott. You are sitting in the US. We always like to start off by asking you a few things about what's happening in the US. We're far away from there right now. Interest rates, tell us about what's happening in that space, perhaps medical, commercial real estate, anything you can help us with to understand what's going on over there.
Sure. So interest rates still are on the rise slightly in the US. As far as transactions, specifically for medical office, that has picked up a lot since 2020. Specifically for this deal, we were able to get great interest rates that we're hoping to close on.
Great. Well, we'll get into the detail of that, I'm sure, in a second. Let's have a look at what is really happening in the healthcare real estate space. And I think this is a fascinating slide. Perhaps, Em, you want to talk a little bit about this? Do you want to just unmute there?
Yeah, perfect. So I mean, if we look at what has happened in the medical space, in the US, just under 20,000 medical buildings have been listed in the first quarter of 2022, with average occupancy rates of 91.7%. Year to date, there has been over $20 billion worth of transactions and sales that have taken place within this medical office building space. Which is versus just over 10 billion and 13 billion in the preceding years. So this space, medical office building space, is becoming a hot property for all people that are looking, at what kind of asset to put their money into.
Thanks, Em.
Further to that, I'd say, we've seen not just the transaction number and volume increase, but the buildings, and I'm sure we'll touch on that later as well, but the cap rates, meaning the cost of the buildings that are coming down, cap rates coming down, meaning, the cost of the buildings are climbing.
Great. So I think the purpose of tonight, ladies and gentlemen, is to dive deep into Medical 41. So it is necessary for us to put up a disclaimer. For those of you who don't know, OrbVest South Africa is a registered FSP. These workshops are for information purposes only. We do not recommend that you buy or sell any securities without getting some prior advice. So please be cautious when trading in these securities. We can certainly help you. We have our own advisors in the event that you would like more information on any particular project. But please, again, just trade with caution. So, Scott, let's bring you in once again. Tell us about your baby.
Sure. So this medical office building is in Kinston, North Carolina. We've been looking in North Carolina for a long time now. It's a great state. Their population is booming right now. But this property specifically kind of stuck out given where it is, right next to a hospital, fully medical occupied, with great tenants. Two of those particularly some large. Sorry, go ahead.
Is the hospital over here, or is it on this side here? Is this hospital here?
It's the hospital's on the other side. So behind this.
Oh, okay, so it's on this side.
But yeah, so fully medical occupied. Two of the main tenants are Moody investment grade, and I can dive into that deeper when we look at the rent roll. But all in all, just a great property. So this is Vidant Health. This is one of the major tenants. They take up a little over 30% of the rent roll. I actually had their tenant interview recently. They just expanded into the building. They executed a 5-year renewal, and they're comfortable where they are. They want to expand into to this region of North Carolina, and they like being right beside the hospital. So these are kind of all the things that we look at when we're going to acquire a property. But as of right now, they're content and actually expect to expand their footprint in this area. So hopefully that's something we can help them with in the future.
Scott, one of the things that we have been caught with in the past is the cost of these multi-story buildings, maintaining elevators, replacing elevators, glass on the fifth floor, et cetera, et cetera. Can you talk a little bit about the structure and the basic cost structure of these buildings, potential maintenance? It is an old building.
Yeah, so a lot of these buildings were built in 75 to 90, so they are a little bit older, more simple buildings. But as far as the underwriting goes, we put a lot of CapEx into the underwriting, so we can maintain some of these properties during our holding period. But all in all, it's a good buy, and like I said, they're just simple properties, and then we can go in and use some of that CapEx to repair roofs, redo some facade, or redo the awnings.
Yeah, so not particularly attractive looking, but very simple structures, sort of brick and tile, which is simple.
Sure. And I guess the big takeaway here on that one is that Vidant they're happy where they are. And it's also a good sign that they just renewed and they're already looking to expand their footprint. So overall, great business in this area. And they see a lot of clients, and the clients in this, particularly for this location, come from miles and miles away. I think they said there are 5 or 6 surrounding counties. And so all of those patients come from those counties just to come to Vidant.
I hope we can give them some decor tips when they get to renovate here.
Yeah.
Again, all the buildings are the same. It's a campus of the, very similar buildings, tile and brick, low maintenance. So, yeah, I think nothing really to talk about there. Perhaps the one building that's just off campus, you can talk about this one.
Yep. So this is Precision Eye Care. They actually wanted to be on the medical park, but there was not enough space since they're 100% occupied. So the previous owners actually bought this for this tenant specifically. It's still on the other side of the hospital, so it's still good walking distance. And this tenant relocated from about a mile away. Just to be closer to the hospitals, because a lot of their surgeries take place at the hospital, and this is more of their consulting center. One thing to note that I found very interesting is they're the only ones in this area for miles that are able to perform cataract surgery, which I found very interesting. So they're there to stay. They like the area. So in all, it's a good addition, a single tenant. Good addition to this portfolio.
Right, Scott, tell me just for the benefit of people online, what is underwriting? What do you actually do? So you get a pack from I assume a broker or an owner, and what do you do with that pack?
So I look at the marketing material, which is the OM, or some call it a SIM, but basically review it. And the first thing I look at are the tenants, are they investment grade? What's the rent roll look like? The tenant reimbursements. Is it a good purchase price? Looking at the cap rate, and then overall looking at the area. Is there growth in the area? So like right here, if we're looking at the rental rates for this area, you can see that they've steadily increased over time. The year-over-year growth is going up, and this property is actually slightly under the average rent for this market. So one thing I do look at is if a tenant is 25, 30, 40% over market rate and they roll during our holding period, we're going to eventually have to reset the lease because that tenant can move to another location. So that's one thing I look at as well. It's better to be slightly under or on par with market rather than over.
What is the blue line there, please?
So that's the year-over-year growth. So you can see that it did slow down slightly, but it's always maintained a positive year-over-year growth. And from 2022, the first quarter of 2022 to the second quarter of 2022, it's still gone up 3.48%. So that's still, there are markets that are negative, and this one has not gone negative. So still a good bit of growth in the past, but overall, it's a positive trend.
And what is the escalation on the leases? Because sort of 6 and 7, it seems to be sitting at 6 and 7 sort of average price inflation on rental. What is the actual escalation on the leases?
On the leases, it's between 2 and 3%. And it's a mixture for each tenant.
So when you get to roll, the chances are you'll roll up because obviously growth would exceed your escalation.
Yeah, and so sometimes it's good to have tenants roll during your holding period, assuming that you've done your due diligence and they want to stay, which we have, and these tenants like this area. But if the market is outpacing the lease terms, then it's actually good to have a lease that rolls over during your holding period, because you can kind of capture that lease and then correct it to what market is rather than continue at your 2%.
Great news. And I remember you talking to us about our big cities, the likes of the Floridas and the very attractive glass buildings and fantastic cities. There's a lot of competition from other offices, and I think what's unique in this particular area is the lack of vacancy. Perhaps you could talk a little bit to that.
Yeah, so historically this market has shown great occupancy levels. And just from the research that I've done, or we've done, is that there's not a lot of medical space here, which is a good thing. There's not a lot of space for our tenants to move to. There's not a ton of medical development. And so the tenants that are there, the ones that I've interviewed, have been there for a long time. Like I said, the properties were developed between the 70s and the 90s. And about 40% of the rent roll has been there from the 70s. They're content where they are. Sales are doing great. The number of patients have increased. All in all, just very positive input from the tenants.
Right.
Yeah, and I think the numbers even on the office space, not just the medical office building space, is also really low from a vacancy point of view. So when we look at, with not a combination of the two, with no real new medical office building development planned going forward, when these leases come to renewal, there is very little or no option for these tenants to move into another building.
Thanks, Anne.
Yeah.
Perhaps let's discuss the dynamic between the two of you. I think it's a good opportunity to do that. Scott, you put together a series of presentations for the investment committee. So we want to know what Emma actually does. Em, you actually also involved in some analysis, but effectively checking Scott's numbers. Is that not correct? You are effectively have to get the information to the investment committee and validate it. Perhaps you can talk about that dynamic quickly while we've got you both online.
Yeah, so I think it's always teamwork. You've got the likes of Scott, which is fantastic, sitting in America, finding the deals, feet on the ground, interviewing tenants, knowing the brokers, the buildings, all of that. And then there's the element where we've got to, just from a risk point of view, the fundamentals that underpin every single building that we look at. What percentage is medical tenanted? What is the market averages from a purchase cap rate point of view, from a rate per square foot, you know, market related to what we're buying it at. So we look at, you know, population and migration in a certain area. We'll look at new medical office building planned within a 1 mile, 5 mile, 10 mile radius of our building. You know, we look at all the fundamentals that underpin all these buildings and just check that the information that's provided is in fact competitive for the purchase now, but also not just in the short term, but for when we are looking, you know, from a 5-year point of view for a purchaser coming to acquire these buildings from us. Is it going to be a desirable building, and are our numbers going to make sense for them when we're looking at exiting these buildings?
And what level of approval has this got from investment committee at the moment? Is a series of M levels?
So,
yep.
There you go.
Yeah, so we've done the M20, which is the initial stages of us bringing the deal to the investment committee and get approval. And then from there, we sign the deal and it goes under contract. So after that, we perform a series of due diligence. So just checking into, you know, is the seller credible? Is the things that he's saying on his OM accurate? We run PCA engineering reports, environmental reports, lease audits, and just make sure that what they presented is the truth. And from there, we go to an M30, which is us presenting everything to the investment committee and making sure that they want to proceed with the deal.
Yeah, thanks. I think that's pretty interesting, guys. Normally we don't get into this sort of information. Going back to the deal, simply, what are we paying for this building? What are the fundamentals? Scott?
Sure. So the purchase price on the building is 11.2 million. That's roughly a cap rate of 8.95. It's not on this page, but I know that because I know this deal by heart. And overall, the hurdle rate 7%. We're actually above that, with the cap rate being so higher than that. The cash on cash to investors is going to be above that 7%. But on this, one thing to make note of is that the DCR, which is debt service coverage ratio, is sitting at a 2.47. Banks usually
maybe just to explain, you know, sorry, just for those that don't understand what the debt service cover ratio is, it's how many tenants don't have to pay their rental in order for you to still cover your debt.
Yeah.
So in this case, you know, more than 50% of your tenants, if it was a 2 times debt service cover, 50% of your tenants aren't paying their rental, and we are still in a position to cover the debt.
So thank you, Emma. So from this perspective, on this property, we're sitting at a 2.47, which is a great number to have on a property. And banks usually want their properties to have at least a 1.2 or 1.25. So overall, it's a good number.
And I think another thing to note is that to make these buildings really work from an IRR point of view, because these are stable buildings, so they're more core and core plus. You know, for those of you who have invested previously with us, you'll notice that the carry profit split, in other words, the share that we get, the waterfall that we get, is much lower than in days gone by. So that's really to make these buildings, to keep the IRR very strong. That's the last 2 lines there. So I think that's also good to note. And then returns. So I think we need to get down to the returns. You talked a little bit about it being above the 7% hurdle. Talk about the cash flow of this building, Scott.
So from year 1 and 2, so one thing I did in my underwriting, which is just analyzing the property, is that we have interest only for year 1 and year 2, which means we're only paying principal on the loan. So that additional money from the cash flow will actually be going into a reserve that we'll put away just in case as a buffer. So year 1 and 2 collectively will add up to about 275,000. And again, that's just going to a reserve just in case, you know, it needs to go to something additional on the property. But the IRR in this deal is sitting between 11 to 12. But the thing to make note of is the cash on cash specifically. It's still upward trends all the way from 8 to 8.8%.
That's a very, very strong cash flowing deal, but there's not a lot of value add in it. Great, thanks. I think just an important thing for South African investors, we used to show the investor return and the South African investor return. I think, we're concerned about it being a bit misleading. Obviously, you have your own tax implication in your country of domicile. So we have just taken that out and put a little footnote there to say that the tax implication of the funds arriving in your wallet in the Seychelles is probably 1%. So, if you're looking at 10 to 11% as opposed to 11.12, if you are using the merged listed environment. Great. Let's talk about the rent roll, Scott, because I think that's vital. This is the people that are ultimately going to pay our distributions and dividends.
Sure. So the first thing to note is that the property is 100% occupied. And the previous owners actually synced up the leases for Vidant and UNC Health. So you can see there, all of those tenants, they all have the same ending date, which is a good thing. You don't want it scattered around. But to dive in a little bit deeper, the previous owner actually expanded UNC and Vidant, which just shows just another positive thing about this property is that these are two massive healthcare companies that are competing for space, and they want to grow in this area. Vidant Health actually bought one of the practices. It was a Kinston clinic. They actually bought them and just kind of added them to their umbrella. And let's see, the other tenants, so Vidant and UNC have been here in the property for a while now, but if you just make note of the other tenants, and I think I mentioned this earlier, Kinston Clinic Pharmacy, ER Imaging, Kinston Head and Neck, and Dermatology Associates. They have been there since the 70s or 80s. They're content in the space. They like it. They like the area. Their patient numbers that they're seeing have recently gone up. So all in all, just a very positive, sign that you want to see your tenants have. And then I think I saw a question about Vidant Health and UNC, but yeah, they're both just big, or they're very large healthcare systems in specifically the Carolinas. And so, I mean, they do everything from primary care and all different types of specialties as far as surgery and things like that.
Yeah, great, thanks. I wasn't watching the questions. I beg your pardon, guys. Please, if you've got questions, pop them into the Q&A. We'll definitely get to them at the end of the presentation, but probably a good time to stop and ask a few now. Explain.
I think that's fine, yeah. That Vidant Health specific question, they're a 1,447 bed hospital system, and they serve more than 1.4 million people in 29 northeastern Carolina countries. So they really are huge and perfectly located in this building. As well.
So I think the interesting thing, Scott, is that these are actually feeders for the hospital system. So while they do provide basic laboratory services and basic X-ray and all that, all they're really doing is they're trying to hook the really serious procedures to send them into their hospital systems to keep the hospital systems full. So I think that's quite fascinating, the competition between the two of them. But so I want to call it a family practice, but it's a lot more than that, because they do basic small imaging and laboratory and small procedures. I hope that answers your question. Oops, anonymous. Next one is what is triple net rent? I think you need to give a little bit more information on that. Perhaps you can also grab that, Scott.
Yeah, you mean what is triple net, or what is triple net rent in this area? But we believe it's so Vidant Health is triple net. So they're looking at their base rental of $14.59, and then on top of that, they're paying their CAM taxes and insurance. So that's roughly what triple net is. And the slide before where we were talking about rent, that is triple net in the area.
I think maybe just expand on that. Explain what is triple net. Why is it called triple net?
So triple net, the 3 N's stand for CAM taxes and insurance. So the tenant would pay their base rent and then get reimbursed for the landlord would be reimbursed for the CAM taxes and insurance for the property. So overall, it's better to have triple net rents because it's less exposure for the landlord in case there is higher inflation or something goes on with the CAM taxes or insurance. So it's not a bad thing to not have it, but overall, it's good to have triple net rents.
Yeah. So basically, on triple net, all of the costs associated with running the particular building, and that can extend to aircon or HVAC as they call it there, roof, etc. These are they full triple net or just triple net?
These so Vidant Health is triple net. The rest we're looking at converting to triple net, and that's going to kind of be our strategy on this deal, converting those tenants to triple net. But right now, Vidant is the only triple net tenant.
Yeah, I think that's actually a pretty good question. Triple net is very attractive, especially in this market where you have inflation. You might have increased costs against your insurance, etc. And in the event of a triple net, you just pass that on to the tenant. So thanks for that. A great question from John, and this is very important because this is quite a move away from the original investment committee mandate only to go into cities that have a minimum of 1 million people. Why is it an exception that we have taken on Kinston, which is a relatively small town, if I can call it that?
You may take that one.
Yeah, I'll go for it.
Okay. So I'll start big picture. North Carolina, just a great state to invest in. Specifically it is a smaller town, but if you look at the market report and the things that are going on in Kinston, you have a lot of activity. One being there's a airplane company who works with military who's coming in, and they're going to add I think it's at 500 jobs, and it's going to be close to $100 million project. So when you're dealing with a smaller town like that, any impact that this company has that's bringing $100 million and 500 jobs to the area is a big impact to this town. And then going deeper just into the property itself, of the tenant interviews that we've done, Kinston Clinic, ER imaging, it's roughly 40% of the property. They've been there since, like I said earlier, they've been there since the 70s and 80s. These tenants are content. They're happy where they are. And they've actually seen an uptick in patients that are coming in. And then also we've noticed even in the larger cities that we're purchasing, everyone likes being right beside a hospital. And so all of these tenants that we've interviewed, they like being right there. They like being in the medical node, and they're happy where they are. So that's your reassurance that these people aren't going to leave.
Scott, I need to just point you to that sort of hub and spoke thing, because also, that was part of the motivation that actually this doesn't service only Kinston. It is a medical hub in the greater area, but I don't know the area, so you're going to have to tell us what other towns and cities are serviced by this particular medical center. Sure.
So part of the tenant interview process, we were just asking where their patients were coming from, and the patients. There are smaller towns outside of Kinston where people travel 60 miles just to go to this location to go see these physicians. So the hub and spoke, I mean, you're looking at people from surrounding counties, smaller farming towns that are coming all just to this medical facility. So tons and tons of people who don't have medical in their smaller towns go to Kinston, North Carolina.
And less, less than an hour drive, you've got Newbern, Jacksonville, Goldsboro, and because of the location and the easy access to the US Highway 70 and the 258 and the NC Highway, there are a couple easy accessible roads to be able to get in and out of this location.
Yeah, so definitely services a big area. Quite a few questions going through, so I'm going to try and keep the cadence up there. We are just going to also just remind you of 2 other deals, so I don't want to run out of time. Johan, what is the minimum maximum investment? Let's give this to you. Em, you've had a bit of a holiday now. What is the loan to value ratio? I think that's very important. And then this one here, you can probably touch on, or we can give it back to Scott. What happens on the rollover at 2027 when leases expire? Do all tenants have the option to extend? What are the terms of the extension? Good questions. Thanks, Johan. Em, you kick off.
Perfect. Yeah, okay. So, minimum investment amount is $5,000. Maximum, depending on whether you're going direct via the US or as an individual going via, the Seychelles. If you're going via Seychelles and the merge, it's roughly 10% of the capital raise amount. So really, maximum investment amount, we can discuss that offline, but minimum $5,000. Our loan to value ratio, Scott, correct me if I'm wrong, was around 63% on this building.
That's correct.
And then at the end of the 2027, when the leases expire, prior to that, we would obviously have started negotiations with the tenants. In fact, it's generally that they come to us a couple of years prior to their leases expiring, wanting to renegotiate their leases. And Scott, you might want to jump on if they all do have the option to extend. My understanding is that they do and will, prior to the expiry date of their leases, start to renegotiate a further term. Ideally, with our strategy on this is at that point to look at converting the non-triple net leases to triple net, which obviously adds further value and increases income to this building.
Yep, absolutely. So we did plan for additional TI and LC as well as CapEx, but specifically TI and LC is money that you can persuade and get the tenants to extend their leases and stay. So all the money that they draw from the TILC could be used for building out their space a little bit better, new shelves, new carpet, anything like that. But in this property specifically, we have plenty of TI and LC for the tenants when they roll over to help them do just that and help them build out their space. But all the tenants have options to extend.
And so to incentivize them, really, I think on this one, we had, in the cash flows, put a tenant installation reserve of over $500,000, so again, to incentivize the tenants to renew those leases and offer them some TI spend.
Yep.
Great. I think we have covered a lot of this. Look, I don't quite understand your question here. Can we get the info on the prop which OrbVest used to buy this prop? Perhaps you can just message us again and explain that. Otherwise, we'll get somebody to contact you later on. Manu, is Kinston surrounded with larger towns, I assume, in a reasonable radius? I think we've covered that. It actually does draw from a 50-mile radius, if I remember, Scott, in your motivation. And there are some towns like I think Charlottesville that you didn't mention that it actually feeds from. So it is a medical hub. That is why the big hospital is next door. I hope that answers that. Manu? Ben, age of the establishment. I think, Ben, yeah, we touched a little bit on that. I think these buildings are certainly not beautiful, but they are very low maintenance. It is a brick with tile roof. I think there are some newer buildings that might be timber clad with brick. But, you know, if anything, the upgrades are not going to be expensive. The things that cost you money are flat roofs and lifts and big air conditioning plant. I think the other important point, Scott, is that 70% of the air conditioners were replaced by the previous owner before the sale. So, you know, a lot of that has been mitigated. But yes, some money is being provided, and perhaps, Scott, you can just give us an idea of what you have provided money for the maintenance and upgrade, because you do have some money in your PC for getting in there and just tidying the place up.
Yep. So the main things we look at that we're going to have to replace on a property is the roof, the HVAC, the parking lot. Those are the three big ones. The previous owner has already done some parking lot restriping and repairs. More than likely, we're going to have to do some, and that's covered in the CapEx that we have set aside for the property. HVAC units, like Justin said, 70% have already been repaired by the previous owner. And so the money that we have set aside for CapEx can easily replace the other 30%. I know the awnings was something that needs to be repaired, but everything that we have that we're going to fix will be covered in the amount of CapEx that we have set aside for the property.
Thanks. Two questions from anonymous. Certificate of need required in North Carolina. I don't think it's relevant to this building, these buildings particularly, because that's predominantly for very heavy medical. But can you answer that, Scott?
Yeah, I don't think that there's a certificate of need for this area.
Perfect. And then the big question is, there a sponsor on the project? And I think this is very important, guys, and I want to actually take this question. I think that of all the buildings that we have had issues with in the past, they have always been through a sponsor. And our preference is not to use a sponsor. We are very good at managing buildings. I think that if we control the building, that we feel a lot more confident in the deal. Most of the buildings, and Emma, you're going to have to correct me. I can't remember how many, but I think it was the last 5 or 6 buildings that we've done without a sponsor. That means we buy it on our balance sheet, and we are 100% responsible. We find a local property manager to look after the day-to-day operations, and we use a software system to monitor every single transaction that happens, every payment that's made in or out of the account. Comes across that particular software system that we operate. And then, of course, we have a member of the team that travels to the buildings to inspect the work done by the particular property manager. In this case, Scott, it's quite interesting because we actually taken over as part of the deal the person who's been running this building for 10 years.
Yep. Yeah, exactly. So the lady that's been doing the property management on this building has been there for, like I said, roughly 10 years. She knows all the tenants. They're comfortable with her. So one thing we're going to do is not interrupt that, and we're going to keep her on, still maintaining and managing the property.
Excellent. Yeah, just trying to really hammer through these. We're very mindful of the time. Is there benefit to the tenant converting to triple net? So what is the benefit? What's in it for the tenant? What do you say to the tenant when you negotiate that lease? Scott, I know that's not your job, but what would you say to the tenant?
I mean, it's just part of a negotiation. If they want to convert to triple net, which, you know, it's possible to convert UNC and the rest to triple net. The previous owners have converted Vidant to triple net. So I definitely think it's a possibility to do it for the remainder of the tenants.
Yeah, I think basically it's a situation where you can either pay, you know, a higher rent without the triple net, or a low rent with the triple net. And so it's basically a negotiation around that. Simagela, how do you recoup your expenses you paid to get the buildings ready for occupation within a period of 5 years? Is the time period not too short to recover your expenses? I think probably this needs a little bit of a bigger explanation. And you want to talk a little bit about how we operate? I mean, the first thing is this is not a new build. This is a building that's fully tenanted that is already pumping out money. So we don't actually have to allocate anything. We acquire the building. There's costs in acquiring the building. And then at the end of the period that we mandated by you to hold it, which is 5 years, we sell it. There will be some capital growth, provided that you don't lose tenants. And then, of course, that capital growth we share with you, and that's where our majority of our incentive is. So I'm not sure if that answers your question, Simangela. Em, I don't know if you want to add anything there.
Yeah, I think maybe just maybe if it's in terms of costs with regards to putting tenants into the space, or that often we will incentivize a tenant and we'll give them tenant installation money to fit out a space of theirs, for example, and we will then factor that into their lease negotiation. So from a tenant point of view, they don't have to come and spend their $1 million, for example, fitting out their space with specialized, walls and equipment, or, whatever it may be. We'll actually facilitate that, but then we recoup it within our lease. So it's positive for them from a cash flow point of view, not having to outlay that money, but positive also for us because we recoup that in the cost of the lease agreement. And generally, it means that those tenants are going to be there, for a longer time, because they've spent that money on their rental space.
Okay, some quickies here. We are already in 45 minutes, guys. Very, very mindful of your dinner. I can hear grumbling tummies in South Africa. So Ben, quick one. Capital growth taxable in the US or the RSA? We have spent the last several years using a structure out of the Seychelles. It is a listed structure, and we settle all of the taxes in the USA, and we bring that money out and dump it in the Seychelles. You can then repatriate it and declare your taxable income wherever your domicile is. But at that point, in other words, probably the 10 to 11% cash and cash we're projecting on this would be net of tax. It would be all the taxes would have already been paid in the US. So I think I hope that is important. Ben, another question: cost of capex. We did cover it a little bit earlier on. We have a provision in the estimates, so don't worry about that. It doesn't affect the RRR that we're projecting. It's all built in. And obviously, the risk is mitigated that there would be extreme capex on these buildings because they're so simple. Is the increase in property value included in the 10% projected? Yes, I think the simple answer to that, Emma, is that you have escalation, and because of escalation, your net operating income goes up. And at the end of the 5-year period, the building is worth more in the future than what you paid for it today. So that is where the capital growth comes from, and that is the benefit. This is a very simple, stable building. There's no vacancy that we can fill to add additional value. So the RR is relatively low. In other words, the return that you get per year that we estimate. But the good thing about this is, if you're worried about cash flow, it is a fantastically cash generative asset. Very, very, very attractive from that point of view. And I think I'm going to have to capital growth tax. Well, I think we've done that one, Ben. All your taxes are paid up until the Seychelles. After that, noted, thanks. Okay, great. And I think we're just going to leave the questions. We'll see if we can get to them at the end. So quite simply, guys, let's do a little recap here, and let's give this to you, Em. Just talk to us about why this deal, why do you like it?
Okay, so I think the major two draw factors here are the two dominant hospital systems. Scott has spoken around Vidant Health and UNC Lenore Healthcare, both credit tenants, occupy a big part of the building. And the close proximity, the easy access, through the tenant interviews, we can see that they are very comfortable and happy in the space and aren't looking at leaving. I think we've covered who they are. In the brochures we'll send out to everybody, you'll be able to read a little bit more about them as well.
Yeah, excellent. And I think we had a question earlier on about what is the hospital across the road? Who owns it? Is it a government hospital? No, there's very little in the way of public health care in the US. Most people, I think it's between 80 and 90%, are covered by some form of health insurance. And the hospital across the road, I think, is the UNC Lenore Hospital. So it's privately owned, big credit tenant, and obviously a tenant of ours. Okay, go in.
Yeah, so put your next point there, just.
Yeah, it's just the benefit that, as we mentioned, the town is a smaller town, but why we were able to get this through the investment committee is because it actually services the greater North Carolina area and various towns, and I guess you can call them cities that surround the area, all feed into this little medical hub. Are you seeing my screen there, Em?
Sorry, I think I've just lost you for a second.
All right. The property, again, fundamentals property was acquired at $135 a square foot. I mean, guys, this is pretty much unheard of. We've been looking at 350s and 250s in some of the bigger cities. You would certainly struggle to replace any of these buildings. And that means that the chances of greenfield development happening down the road that takes your tenants is highly unlikely. And then, of course, the cap rate of 8.95. Once again, we just don't see those cap rates. We look at buildings at the moment, Scott, 5.5%, 6% cap rates, very, very expensive, even in this particular market, in this current market. So certainly that was a big win. And then, finally, again, the average rent is super in line with what the market is, a little bit below. And certainly when we get to rollover, we're going to be able to bump those rents a bit and push the value of the building. So, guys, I know I'm rushing a little bit. We'd never go over an hour. So I really want to just recap on two other buildings. So, Em, perhaps you can come in. Can you see my screen now?
Perfect. Yeah, you're back. Great. So, we have spoken in a previous webinar about Medical 40. So let's just, run through it quickly. I mean, this is a beautiful 50,000 square foot building in the northern part of Albuquerque, New Mexico. The building itself is located in one of the most desirable office and industrial corridors, with the central location making it a very easily accessible, across the whole MSA. The centralized location is really the significant reason why the tenants want to be in this building. The biggest risk in this building is this Quest Diagnostic and Sonobello tenants not renewing their space. Quest takes up 45% of that building. So let's deal with them first. We've had tenant interviews with them. They use the space as their centralized lab and testing facilities of all of Albuquerque and central Mexico. They've been in this building since 1999, so for 23 years. It's a very specialized space with refrigeration, hazmat. You can see on the picture the white spaces like the logistics area where vehicles come and go from and service the whole of New Mexico area. They are picking up more shifts. So, if we look at them in terms of why they wouldn't want to leave the space, one, it would be very expensive for them to move, specifically because of their specialized refrigerations and, as we mentioned, hazmat and all of that. There are no new developments that can house this type of facility or space in the area. And also, if they were to leave here, they would lose market share, which they've kind of established over the last 23 years of being there. Through the tenant interview, Scott, you can jump in here, but they seemed very comfortable with the space. They liked being, they liked being in this area, and showed no need to want to leave. On and above that, they have the economics and insurance reimbursements of New Mexico are very favorable and stable to their operations. So we've got very comfortable around Quest. In fact, they have already approached us to discuss extending their lease 2 years prior to their expiry date. So, very positive from our point of view on that. Sono Bello, they take 25.7% of the space as well. They have signed a 10-year lease. They're credit tenants. They are still busy with their installations on their space, and are spending over $1 million themselves on installations, etc. there. They are a very heavy surgery center. And again, when you look at the spend and the cost of what it takes to get that to the specs that they require, the likelihood of them moving, as a wasted cost to them if they were to do that with that machinery, etc., is very unlikely.
Great, yeah, and then just to add, the third credit tenant there is a large Washington-based insurance company. Again, came out very strongly in the tenant interviews. And then the value add in this building, what makes it different to the previous Carolinas building, is that it has vacant space. Vacant space is a risk, but it's also an opportunity. Remember, when you buy the building, you don't pay for the vacant space. The vacant space comes free, because the way that these buildings are valued is based on the income. So you've got a free vacant space there. The medical vacancy in the area is less than 2.6%, which means that the only spaces that are available are little unlettable corner, buildings. And even the office and commercial space vacancy is super low. I forget offhand exactly what it is, but it's also sitting at about 5%. So there is just no space in this area. And we also did an investigation that looks at new plans for building in the area. And because of inflation, people are scared of new builds at the moment, and there is just not a lot coming through the pipeline. So yeah, I think that's super. Why do we like this building, Em?
Yeah, so I think, this is as I stated earlier, the largest city in New Mexico. Albuquerque is the economic and urban center of the state and accounts for nearly half of its economic activity. So again, if we look at other industries that are spending money in this area, Intel, Netflix, Facebook, further to this, Albuquerque is the third biggest oil producing state. Their biggest growth industry is solar. So there is a lot of industries outside of the healthcare that are also happening, in Albuquerque. The building itself, as Justin mentioned, it's 85% leased. So straight away giving us a stable income stream with credit tenants, but also giving us the opportunity with that 15% vacancy to add some value by leasing that space up. A weighted average lease term of 5.9 years. We've covered the risks in terms of Quest, Sono Bello, of them exiting, and got comfortable around that. Very low medical vacancy, 2.6% in the area. And when you look at the fairly specialized and spaces that this building and the location of where it is, it's unlikely that any of those tenants will be able to duplicate or replicate this kind of space in any of those other medical areas. Great location that we spoke to. So, again, another really solid building with lots of other industry happening in Albuquerque.
And Emma, one thing to make note of, can you go back to the last slide, Justin? Sorry. And so just wanted to make note is that the major corporations, Intel, Netflix, Facebook, they're all moving away from California because it's too expensive. So they're moving to places that have good labor, reasonable prices, like I said, a good labor workforce. They're moving there and setting up shop. And so these are just 3 of the major tech giants in the US. And so more and more can continue to follow. So yeah.
Yeah, again, on that, people are moving for the quality of life. It's centered around a low cost of living, business-friendly environment with good tax incentives and economic trade zones, which has encouraged business expansion. In the last 2 years, $2.2 billion has been spent on new projects across varying industries in Albuquerque alone. This is outside of the Netflix and the Intels, etc.
Fantastic. Thank you so much, guys. Like we're really up to our hour. Once again, as I say, we want to close in an hour. I just need to mention we've shown you 2 buildings tonight, and I think it's sometimes quite difficult to understand. There is risk in investing in a single building, although we do not do any high risk buildings anymore. We used to, but it gets us into trouble. So our buildings now are what we call core or core plus, and that means they are generally lower IRR, but a lot more secure in the fact that they can generate, good cash on cash, which means the dividends keep flowing. However, we have now started to do quite a lot of business now with financial advisors, and they are putting people's pension money into a building. We are uncomfortable with that. And so a few years ago, we started putting a bunch of these buildings together in a kind of a mini fund. Now, it is a mini fund because it's actually not very big. You know exactly what buildings are here. They're all our OrbVest buildings. They're all our buildings that have been through our credit committee. They're all our buildings that have been performing, save for 1 or 2 that are not worth mentioning. And this is if you are looking for a relatively small investment and you want to be absolutely secure and sure of your dividends, OrbVest Diversified Holdings has an excess of 100 medical tenants that are paying your dividends for you. So anything can happen to one tenant and it won't affect the overall returns that you get. It's got a huge diversification. I think it's 23 or 24 buildings already, and it's got a share in those buildings, and it will have a share, for example, in 40 and 41. So just to give you an idea how the spread works. Any information on this, please reach out to us and we'll feed you any info on this. This is the safest 4 sort of product that we have. And on that note, I want to bring the webinar to an end. There are a lot of very good questions here, and guys, we will hang in and answer these questions for you. But for the rest of you, if you would like to go and have your dinner, we just want to bid you farewell and thank you very much for joining us. Please shoot any suggestions you've got, any particular information you'd like to get from us. We are talking about doing webinars on a slightly different basis, perhaps even bringing in some of the investment property invest for a passport. In other words, you've heard of the Portugals and the Cypruses, and perhaps having a debate about that. Remember that a lot of these countries are now opening up. If you have foreign income, in other words, you've got money flowing from offshore, you can actually get residency in one of these countries. So I think that is quite interesting. But please come with suggestions. We're here to help, and certainly just reach out. So once again, thank you. We will stay on and answer these questions. But for those of you who wish to leave, good night and thank you.
Thank you.
All right. Roelof, if you invest from South Africa, must you go through the Seychelles, or can you go direct under the 1 million discretionary allowance? So I think this is also a great question. Remember that you are allowed to take out a discretionary allowance of R1 million every year out of South Africa. And of course, your spouse can also take it out. The investments or dollar-based investments that you would make here through your financial advisor are most often funds that are held in South Africa that you invest in, and then they take your money offshore and they invest it in whatever it is that fund is geared up to invest in. This is quite different. we are offering a product that is completely offshore. It actually has nothing to do with South Africa. You are either investing directly into the US, but that is not really, we don't recommend it unless you are sort of in the $1 million category. Or you can invest via the Seychelles, which is very efficient and, as you know, is a tax-free zone. So what you would do is you would go to your banker, or you would go to a forex dealer. You would move your $1 million rand, about 70,000 odd dollars, to the broker in the Seychelles, PKF Capital, and they will hold it in escrow. They will credit your wallet, and you will be able to then make the investment into one of the OrbVest buildings. I hope that answers that question, Rudolph. Again, yeah, please reach out. We'll give you a lot more detail on a face-to-face. We did the cost of capex. Johan, please explain the hurdle rate on this deal. Do you have a detailed investor pack with more information on the investment opportunities? Absolutely, we will send that to you, Johan. Perhaps we could even get someone to call or come and see you. Ben, okay, great, thank you. Chins, sorry folks, got to go. Okay, excellent, thanks for attending, very good of you. And I think that we have a few that we might have missed here. That was the minimum investment, loan to value, we covered that. How do you recoup your expenses? Big pardon, we covered that. Rudolph, we covered you with leases, more or less. At the exit time for the deal, are you assured they will renew? Anonymous, there is obviously always a risk that that tenants will not renew, and I think you need to take that into account. In this current environment, we are actually more welcoming of the rollover, because the rollover gives us the opportunity of catching up inflation. And to be sort of basic about it, if you have a rental of $16 a square foot, and you have escalation of 2% times 5 years, that's not very exciting if inflation is running above that. So you will find in 5 years' time, if inflation continues to run in the US, your escalation at that point might be 10%. And so if you can roll over those leases at a 10% escalation, and you can control your expenses, because remember that it is the profitability of the building that establishes the value, then you can bump the value of the building really, really nicely. And I think if we bring it back to South Africa, if you bought your house 30 years ago, the chances are you've got a lot of equity in it. Why? Because the house appreciates over time for a number of reasons. The same thing applies here. The buildings appreciate. Why? Because people are paying more for their service from the doctor, and the doctor in turn is paying us more rent because we can demand more rent for him. And why doesn't he leave? Because he can't go across the road to the other building, because there isn't one, and someone has to build it. And if they're building a new one, they're going to be spending $300,000 to $400,000 a square foot to build it. And that would mean that their rent would be in the region of $20 a square foot, or $25 a square foot, in fact. So once again, you've got cost push, as well as the push from the increased rental that you can charge. I know that was a complicated long answer, but I hope that we got that one right. Guys, I think that we are just about there. If anybody is interested in any further information, please reach out to us, support@orbvest.com, emma@orbvest.com, scott@orbvest.com, but be careful, you'll get an analyst's reply, or myself, Justin@orbvest.com. And thank you very much once again for attending. We had a fantastic turnout tonight, so appreciate that. Cheers.